Look at this single drop. To the consumer, a digital transaction feels exactly like this before impact, a contained, instantaneous transfer of capital from point A to point B. You tap a screen and the money arrives. The reality of that transfer is a fragmented cascade of routing, clearing, and settlement. The moment a user initiates a payment, the data is handed off across a gauntlet of specialized intermediaries. This diagram shows what actually happens. The direct connection shatters into a network of acquirers, payment gateways, processing networks, and issuing banks. Each node must authenticate, encrypt, and authorize the transfer in a fraction of a second. By fragmenting the process to achieve speed and scale, the payment industry exponentially expands its attack surface. The risk does not just lie within the individual institutions, but in the spaces in between them. This complex ecosystem faces two distinct vectors of attack. The first is systemic abuse, illicit actors weaponizing the legitimate payment rails to launder money and evade sanctions. The second is systemic compromise, hostile cybercriminals directly breaching the network's perimeter to extract funds and data. To survive modern regulatory scrutiny, financial institutions must map this fragmented architecture with absolute precision. They must pinpoint exact nodes of liability, isolate structural vulnerabilities, and prepare their infrastructure for an incoming era of automated machine supervision. To understand how regulators govern this sprawling network, we have to strip the ecosystem down to its structural core and identify exactly where legal liability is initiated. This architectural blueprint isolates the central node of the modern regulatory perimeter, the payment service provider, or PSP. Sitting at the exact intersection of the user, the merchant, and the wider financial system, the PSP operates as the ultimate gatekeeper. This requires clearing a rigid legal boundary. Regulators demand strict licensing and authorization protocols before touching a single cent of consumer capital. Once authorized, the PSP must construct dense internal governance structures. Regulators require segregated safeguarding accounts, strict capital adequacy ratios, and comprehensive internal risk management controls to ensure the institution remains solvent. But solvency is insufficient on its own. A PSP must prove operational resilience. If a payment gateway goes offline, commerce halts. Therefore, maintaining continuous system availability is treated as a critical operational duty under the law. PSPs frequently rely on third-party cloud computing and specialized tech vendors to maintain this resilience. However, a PSP can only outsource the function. It cannot outsource the liability. These vendors must be tightly monitored and tethered back to the PSP's core risk management framework. The PSP acts as the network's legally liable anchor. It holds ultimate responsibility for enforcing the integrity of every transaction passing through its perimeter. That perimeter is constantly tested by systemic abuse. Illicit actors do not want to destroy the payment rails. They want to use them to launder organized crime proceeds and bypass international sanctions. Notice the data packets flowing through this network. Systemic abuse is exceptionally difficult to mitigate because it exploits legitimate pathways. The illicit transactions are formatted correctly, authorized properly, and virtually indistinguishable from standard commercial traffic. The regulatory first line of defense is a strict physical checkpoint at the moment of onboarding. Customer due diligence and Know Your Customer (KYC) obligations force the PSP to cryptographically verify the exact identity and corporate structure of the entity opening the account. Yet KYC carries a critical vulnerability. It only verifies the user's identity at a single, static point in time. A perfectly legitimate corporate account opened on Monday can be sold to a trafficking syndicate by Friday. To counter this, regulators mandate continuous transaction monitoring. The PSP must deploy algorithms that track velocity, geolocation, and behavioral deviations to detect anomalous activity long after the initial onboarding phase. The stakes compound when dealing with sanctions compliance. Facilitating a transfer for an entity on a global sanctions list carries strict liability. Regulators do not care if the PSP intended to process the payment. The failure to intercept it is a prosecutable offense. Simply blocking the transfer is insufficient. Institutions are legally required to file suspicious activity reports, actively mapping out the attempted illicit flow and handing that intelligence over to financial intelligence units.
When legitimate rails are weaponized, a flawlessly executed transfer can still result in a catastrophic compliance failure. The network must constantly interrogate the legitimacy of its own traffic. The dynamic shifts entirely when facing systemic compromise. Here, hostile actors abandon deception and actively assault the network's technical and psychological defenses. This physical lock manipulation mirrors the brute force applied to user accounts. Cybercriminals deploy identity theft and account takeovers and highly targeted social engineering to steal user credentials and bypass the initial authentication layers. When a fraudster drains a consumer's wallet using stolen credentials, the PSP faces heavy consumer protection liability. Regulators often hold the institution responsible for refunding the victim, arguing the platform's authentication protocols were inadequate. Watch the merchant note here. Attack vectors on this side look different.
Organized syndicates exploit the dispute process, triggering mass chargeback abuse and refund manipulation. The capital flow is forcibly reversed back out of the core PSP, leaving the acquirer to absorb the financial loss. Regulators mandate proactive perimeter defenses to absorb these attacks. PSPs must maintain rigorous cybersecurity standards, continuous penetration testing, and immediate incident response protocols to contain the blast radius of a successful breach. A breach inevitably exposes sensitive consumer data, instantly entangling the PSP in strict data protection laws like GDPR. The institution must lock down the compromised servers and preserve the digital evidence for forensic auditors. For a payment provider, an IT security failure triggers a catastrophic reportable compliance violation. The legacy regulatory frameworks were designed for centralized hub-and-spoke networks. Today, those architectures are being dismantled by open banking API ecosystems. In this updated model, the rigid boundary dissolves. Open banking mandates require banks to expose their core infrastructure via application programming interfaces. Third-party fintechs now pipe directly into the payment rails, embedding financial services into e-commerce sites and non-financial platforms. Running parallel to this API disruption is the explosive integration of cryptocurrencies, stablecoins, and central bank digital currencies. Decentralized currencies present a severe compliance paradox. They operate on mathematically sound, cryptographically secure ledgers, yet their pseudo-anonymous nature creates massive blind spots, completely bypassing traditional compliance checkpoints. Because decentralized networks move capital globally in seconds without relying on a central clearinghouse, they create immense jurisdictional friction. Regulators struggle to determine which country's laws apply when an asset exists simultaneously on thousands of distributed servers. Emerging models offer unparalleled speed and interoperability, but they break the hub-and-spoke framework. Human-driven compliance teams cannot manually track money moving through decentralized smart contracts and embedded platform APIs. The sheer transaction volume and the density of this interconnected net compliance teams. These sorting data points visualize the mandatory pivot. To survive, institutions must deploy regtech, regulatory technology, to automate risk management and process millions of inputs at scale. Advanced compliance algorithms must simultaneously monitor API traffic spikes, fiat currency gateways, and blockchain ledger activity in real time, executing risk calculations in milliseconds. This overarching dome represents the regulatory endgame, suptech, or supervisory technology. Financial authorities are no longer waiting for quarterly reports. They are deploying their own algorithmic tools to plug directly into PSP databases, assessing systemic risk across the entire ecosystem instantly. Regulators will increasingly rely on automated reporting. As institutions delegate oversight to algorithms, they will face strict liability for any algorithmic failures. If a machine learning model incorrectly categorizes a sanctioned entity, the institution pays the fine. The digital payments ecosystem has evolved from a linear pipeline into a living, decentralized matrix. Financial crime exposure can no longer be managed by human observation. Moving forward, the integrity of our global economy relies entirely on machines watching machines.